And good evening, Hampton Roads. Welcome to another edition of Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, Certified Financial Planner Kevin Zibna, coming to you live like I do every second and fourth Tuesday of the month to dialogue with you, take your calls. If you have a question or comment relating to your own personal financial situation or anything I'm talking about here tonight, jump on the phone lines. Give me a call, 627-7979. All we need is your first name, city you're calling from, and no matter what I'm talking about, if it's important to you, then it's important to me. We'll get you right on air. 627-7979. Wealthway Financial Advisors is the proud sponsor of Dollars and Common Sense. We are an independent registered investment advisor, which means we're legally held to a fiduciary standard to put our clients' interests ahead of our own in any business dealing or recommendation that we make, and that's the way it should be when you work with a financial advisor. As the premier financial planning firm in Hampton Roads, we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. So by design, we can't work with everyone. We work with a relatively small group of high net worth clients, but that's one of the reasons we feel so strongly about coming here every second and fourth Tuesday of the month at 6 p.m., and that's to reach out and help as many people in the Hampton Roads listening area that we can achieve your measure of financial success, because it is a core belief at Wealthway Advisors that the overwhelming majority of people in this country have the opportunity for financial security if they choose it. And it is a choice because it takes some time, it takes some effort, and it takes some knowledge. We are here to help. You got to take that first step, though. Pick up the phone. Give me a call, 627-7979. Whether you want to talk about anything having to do with the investment markets, the economy, insurance products like life insurance, health insurance, property casualty, taxes, tax planning, tax reduction strategies, retirement planning, retirement plans, 401ks, 403bs, TSPs, IRAs, Roth IRAs, mortgage options, Social Security claiming strategies, or estate planning, wills and trusts. All that and more falls under the umbrella personal finance. We are here to discuss tonight. All right, tonight will be end of year planning part 2. Part 1 was last show and 2 weeks ago, and if you want to catch any of that, you can check it out on our website, wealthwayadvisors.com, where we put up our last 8 or 10 last shows, and we even have some through the fancy use of technology, we've converted the audio into written words. So if you'd rather read than listen, you can also do that at the website, wealthwayadvisors.com. But we're going to go on, pick up from where I left off on that show and talk about more actions you can take before the end of the year in order to set yourself up for a successful 2026. And one of the areas that I left off on was talking about Medicare and the potential introduction of IRMAA charges. What is IRMAA? So essentially, if you make over a certain amount of income in a given year and you are on Medicare, then you pay an additional premium for that Medicare coverage. So the more you make, the more they're going to take in order to pay for your Medicare coverage. And people who are on Medicare but not yet claiming Social Security pay it in a monthly bill. Most people who are on Medicare are receiving Social Security benefits, and so their Medicare premiums are automatically deducted from that Social Security check. So you don't have to write write a separate check to pay the bill, but it is real. I'm sure everyone who pays it feels it, and it reduces the amount of your Social Security payment because it's deducted from that. So some numbers to be aware of, and I'll try to keep this as numbers light as I can because things get a little bit bogged down when I get too technical or get too many numbers involved We're trying to explain it on the radio. But basically speaking, there is no additional payment for Part B. First of all, Part A, no one has to pay extra for Part A Medicare coverage. It's Part B and Part D. So if you are filing single, and you make over $106,000, then you are subject to pay an additional monthly premium of roughly $88, or roughly $175 if you, $87 for a single. If you're married filing joint and you make over $212,000, then you have as a couple, you have to pay approximately $175 per person. No, I'm sorry, $87 per person, $175 for the couple. There, I got my numbers right. Sorry for making that extra confusing. And then it just goes up from there. So singles greater than $133,000, that's another $220 a month that you have to pay in your Medicare Part B and Part D coverages. And for couples married filing jointly greater than $266,000, then combined you would have to pay another $440 a month. That would be deducted from your Social Security payment. So I'm not going to go through all the tiers there, but just know that the more you make, the more they take. That the excess IRMA premium. Oh, by the way, IRMA stands for Income Related Monthly Adjustment Amount. Great government acronym there. So the more you make, the more that they will take in order to pay for your Medicare insurance premiums. And it continues to go up the ladder. I'll just give you the top spot. For singles greater than $500,000 of annual income, they pay an additional $530 a month for Part B and Part D. And for couples that are over $750,000, that's another $1,060 per couple that you have to pay in Medicare premium. So those are impactful numbers that kind of happen behind the scenes that people are not very cognizant of when trying to look for tax planning strategies or ways that you can manipulate your income to try to get yourself into lower tax brackets. That most everybody knows, like, the lower I can make my income, the lower tax brackets I go into and the less tax I pay. But then a lot of people don't think of the implications when it comes to the IRMA insurance premiums for Medicare that are built into a lot of times Social Security. So something that we can plan for before it happens, if we know it's going to happen, or sometimes we can reduce or eliminate the IRMA charges if they were due to a financial event that happened in 1 year that is not likely to be duplicated or will not be duplicated in subsequent years. So there's a 2-year look back on the IRMA insurance premium. So what you're doing in 2025 will affect the IRMA premium in 2027. But if you are not going to, if you qualify for a reason to eliminate IRMA because it was like a 1-year event, then there's a form to file, and you can submit that to the Social Security Administration, and you can get that waived or reduced or eliminated. And just something to be aware of. And for those of you who are subject to it, you might want to take a look at your income for this year and see if there's some strategies you can use to try to get that down a little bit to avoid that excess premium. All right, going to pause right here for our first break. Be right back after these messages. Get those calls in now, 627-7979. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm your host, certified financial planner Kevin Zivna, the president of Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight we're talking about some end-of-year planning issues, strategies, tips that might help set you up for a good year in 2026 and help you close out 2025 on a good financial note as well. So this time of year, when a lot of people look to make charitable contributions in the spirit of the holiday. So here's a couple charitable strategies that can help save you some money as well. So, and I might have touched on this last show, but it's important enough to go over twice, even if that's the case. But when it comes to gifting, we all know that we can obviously probably go online, make a direct donation to a charity, put in a credit card, or use PayPal or Venmo or some other electronic transfer app and send money directly to a charity, which of course is great. Any charity is good charity, and it helps that charity, even if you do it. If you just give them straight cold hard cash. But a better, more tax-efficient way for people to donate, if you are so inclined and you have the mechanism to do it, I guess, and that is by gifting appreciated securities like appreciated shares of stock or a mutual fund or an ETF. And instead of giving cash, you give the shares of the stock or mutual fund or ETF directly to the charity. And if it's appreciated, which means it is worth more than what you paid for it, then by giving the shares directly to the charity without selling them and creating the cash, giving the shares directly, then you never have to incur a capital gain on the appreciation of that stock. So you give an appreciated shares of a stock or mutual fund or ETF to a charity without selling. You get the tax deduction for the value of the shares that you gifted on the day that you gifted. And then once the charity gets it, typically within a matter of days, they sell the shares of the appreciated security and then convert it to cash, and boom, then they have cash to enhance their mission. And you get a tax deduction for the full value on the date it was transferred, and you never have to incur a capital gain on those shares, and therefore never have to pay a capital gains tax on those shares because you gifted the shares directly to the charity without selling. So one of our favorite techniques we like to use at Wealthway at the end of the year for people who are charitably inclined and have shares of securities that are appreciated to gift directly to charities. Most charities, I will say, nowadays are sophisticated enough to handle this more intermediate type of transaction. Usually there is some paperwork involved, on one end or the other, perhaps both ends. Charities have to have a stock account capable of receiving appreciated shares of securities, but most of the bigger ones do, and even some of the mid-sized ones as well. My experience has been that charities will find a way to take anything of value that you are willing to give them and convert it to cash to help enhance their mission. So gifting appreciated shares of securities. Another one we like for people who are age 70 and a half or older are making qualified charitable distributions directly to charities from a traditional IRA. This is especially beneficial for people who are subject to required minimum distributions from their IRAs. And right now that's people age 73 or older, but people who are 70 and a half and older can also take advantage of this strategy. And so that instead of withdrawing money from your traditional IRA and having that withdrawal being categorized as ordinary income, which it would, and meaning that you have to declare that on your tax return as ordinary income and pay the highest ordinary income tax rates. If you donate directly from your traditional IRA to the charity without receiving the funds yourself, then that money is never counted as income for you and therefore never taxed to you. Now, you don't get a tax deduction for what you gave to the charity, but you never had to declare that money as income. So when you do the math on, well, what's more efficient? Should I take it out, claim it as income, pay the tax, and then get a deduction on my contribution? Or what if I just give the money directly from my IRA to the charity and never have to declare it as income without getting a deduction? It is almost always more tax efficient to do it that way. In other words, in the whole grand scheme of things, you pay less tax when you donate like that instead of claiming it as income. All right? So that's another technique that we use a lot in our practice as well. And then finally, sort of from a charity standpoint, if you expect to take the standard deduction this year, which 90% of all tax filers do take the standard deduction, and the standard deduction for single people is a little less than $16,000 this year, and for married filing joint, you're $31,500 standard deduction. So if you expect to take the standard deduction this year, you might want to consider bunching your charitable contributions every few years, which then may allow you to actually itemize and claim more than the standard deduction in specific years. So how this would work in practice is, instead of making an annual donation to your favorite charity at the end of the year, you might make one really big one this year and then not make one for the next 1, 2, or 3 years, and then make a really big one again after that time frame is up. So it's a way of getting even more, a bigger deduction on the same amount that you would contribute, but instead of spreading it over multiple tax years, you compress that donation and make it bigger in one particular tax year. And then typically you'd want to make that the total of the deduction and all your other deductions greater than the standard deduction, and you're able to deduct more than you would have if you just gave the same amount over the same over each year instead of bunching them every few years. So that's something that you could take a look at if you have a particularly favorite charity that you know you're going to give to every year. then that's a way that you can do it more tax efficiently. And then before the break here, will you be receiving any significant windfalls that could impact your tax liability, such as restricted stock units vesting, stock options, big bonus at the end of this year? If so, take a look at your withholdings that you have set up on your payroll to determine payments may be required, and making if you do get a big windfall like that, or have got a big windfall like that anytime over the course of this year, you may owe quarterly estimated taxes. And if you don't pay those quarterly estimated taxes and you don't pay enough this year, then there's a penalty involved in that underpayment. All right, got to run away for the first break. We'll be back in just a couple minutes. I'm certified financial planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm certified financial planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can check us out online at wealthwayadvisors.com. Once there, you can request an information packet to find out what it's like to work with us, or sign up for a free quarterly newsletter at wealthwayadvisors.com. Just go to the Request a Consultation page, put your name and address in the dialog boxes there, select the appropriate drop-down menu, and we'll get that information out to you later on this week. And that's all we will use your name and address for, is just to send you the information that you request. Or if you have some nuanced questions, want to speak to a live human being, we got those too. Give us a call at the office, 757-456-2200. Want to remind everybody, our last show of the year will be on Tuesday, December 23rd. That will be a pre-record. I will not be live for that one. Be off visiting family for the Christmas holiday season. But if you can't catch us live, normally every second and fourth Tuesday of the month at 6 p.m., get the show as a podcast. Search for Dollars and Common Sense wherever you get your podcast. Download us, take us with you wherever you go, and listen at your convenience. And if you're into social media, we have a presence on Facebook and LinkedIn. Search for Wealthway Financial Advisors, hit that like or follow button, and then once every week or two, we try to put up an interesting and informative financial planning post to keep you engaged in the process. All right, tonight we're talking about some end-of-year moves that you can make. Still, there's enough time to try to get some savings for 2025, or set yourself up for success in 2026. So for those of you who have a health savings account, you want to make sure that you try to max out that contribution to a health savings account. We are big fans of health savings accounts. They come in tandem with a high deductible health plan. At one time, those were scary words. High deductible health plan. Made it seem like they were unaffordable. There were boogeymen about how that's cheap coverage, that's not comprehensive. No, none of those are true. It's just a different form of getting health insurance coverage, where you, the covered person, just assumes more of the payment of your healthcare services on the low end. In other words, the first dollars that you spend over the course of the year, but then the insurance sits on top of that to take care of any potentially big healthcare bills that you got throughout the course of the year. And this can be, hospital bills, it can be dentist bills, A lot of times, medicines you can use your health savings account to pay for medicines, medical equipment. Over-the-counter stuff, that's a kind of a gray area. Kind of depends on what the over-counter medicine is. But there's a lot of uses that you can use your health savings account for to pay for that portion of the deductible or the deductible that you are responsible for. So here's a little idea of how much you can contribute to a health savings account. Oh, and one of the big advantages of health savings account and why we like them so much is you can make annual contributions to it, but it's not use or lose. So what you don't spend in one year, you can keep in the account and it's available next year, or you add more to it next year. And ultimately, if you build up a critical mass, typically, I'd say at least $5,000, maybe closer to $10,000, then most of the health savings account providers will allow you to invest a portion of the money in your health savings account, and you can grow the money in there with the investment tools available in a health savings account. And then when you need the money for spending, you just sell some of the shares of your investments in the health savings account, turn it into cash, and then use your debit card to write a check out of that health savings account to pay for your health care expenses. But you don't have to use it every year like you do in, like, say, a flexible savings account or something like that, or other types of savings accounts geared towards helping people pay for health care insurance. And if you keep doing this year after year and you stay healthy and don't have any accidents and you don't really use the money in your health savings account, well, it can continue to build, it can continue to grow. And then ultimately, if you have money in a health savings account by the time you reach 65, then you can pull the money out for any reason. It doesn't just have to be for healthcare expenses. You can pull it out for any reason. Now, you will have to pay ordinary income tax on what you withdraw from the account at age 65, but you will not have to pay a penalty on it. And so it functions very similarly at that stage to a traditional IRA account. And it also can be used to pay for Medicare premiums at that point in time. Now, you can't pay the premiums right out of the account, just do the mechanics around it, but you can reimburse yourself for the premiums that you did pay. So for those of you who were here at the beginning of the show when I was talking about the IRMAA penalty that goes along with high income earners to pay additional premiums on their for Medicare, you can reimburse yourself for those higher premiums, pull the money out of your health savings account, and then you've got your money back, essentially. So that's a big reason why we like health savings accounts. They have multiple purposes, they're very flexible, and you get a tax deduction for your contributions to health savings account regardless of income. There are no income limitations. So the wealthiest among us, the highest income earners, still, this is one of the few tax deductions are still available for you. So this year, if you have a qualifying high deductible health plan, then you can contribute as an individual $4,300. Or if you have a family plan, and a family plan doesn't mean you have to have every single member of your family on your health insurance, but as long as you have you and one other person, that could be a spouse, that could be a child, on your insurance plan, then it qualifies as a family plan, and then you can contribute up to $8,550 this year. And if you are age 55 or older, you can contribute another $1,000. So $4,300, $8,550 for family plan, an additional $1,000 if you're 55. And you can do that every year. And each year, typically, those contribution limits creep up a little bit as they're indexed to inflation. And like I said before, if you don't spend that money, it can stay in the account. You do not lose it. You build up enough critical mass. It can be invested for future use. And then once you hit age 65, it can be used for anything, not just medical expenses. Okay, along the lines with health savings accounts, one of the last minute things you can do before the year is up is, if your employer will let you, if your HR department is going to set up for it, is you can maximize your salary deferral contributions to your employer retirement plan. So this year, the maximum contribution limit to most plans, 401ks, TSPs and 403Bs and so forth, is $23,500. And if you are age 50 or older, add another $7,500 to that, and you can contribute up to $31,000 a year to your company retirement plan. Now, if you haven't gotten close to that, but you have some excess cash that you can pull from and live off of, then sometimes you can go to your human resources department and say, take my entire paycheck and put it in my 401k plan. And I want to do it for the last 2 or 3 paychecks of the year. So you backload your company retirement plan. You put in a lot more instead of maybe the $100 or $200 you're doing each paycheck. And you really sort of turbocharge the amount of contribution you make to your company retirement plan. So not all companies will do that. You kind of got to have the HR department and the payroll system set up to do that, and a willingness of upper management to let you do that, because it is kind of an administrative hoop to jump through for the people who do the payroll at your company. But it is possible to do that. You don't have to just make the same contribution to your company retirement plan equally throughout the course of the year. You can switch it up as much as your company and your company's plan will allow you to switch it up. All right, going to take our last break. We'll be back in just a couple minutes. 627-7979 if you have a question or comment about anything I'm talking about here tonight, or anything that's important to you. Jump on those phone lines. I'm Certified Financial Planner Kevin Zivna. You're listening to Dollars and Common Sense on News Talk 790 WNIS.
Wealthway Financial Advisors, planning for life. Wealthway Financial Advisors, planning for life.
And welcome back to Dollars and Common Sense, your local source for objective, unbiased financial advice. I'm Certified Financial Planner Kevin Zivna, the president at Wealthway Financial Advisors, the premier financial planning firm in Hampton Roads, where we integrate expert investment management with customized, ongoing financial planning advice to help our clients answer life's big financial questions and enhance their quality of life. For more information about us, you can look us up online at wealthwayadvisors.com. All right, tonight we're wrapping up the year with our end-of-year planning part 2. Part 1 of this segment was last show and last week. If you're interested in that, you can either get it as a podcast by downloading the show from wherever you get your podcasts. Search for Dollars and Common Sense, or you can go to our website, wealthwayadvisors.com, where we've got the last several shows up there, as well as the print version as well, if you like to read instead of listen. All right, so we were talking about some last-minute moves that you can make before the year is up. Talking about some cash flow issues. If you haven't maxed out your health savings account contribution, if you're eligible for one, you can still do that before the end of the year. You can try to backload your company retirement plan and try to get close to the maximum contribution limits for that? How about those of you with kids and have aspirations for them to go to college one day? Well, then a 529 account might be of interest to you. And if you don't have one, now's a good time to consider opening one. You just have to have an actual child in order to open one, and that child have a Social Security number. And I think almost all babies are exiting the hospital nowadays with a Social Security number. So with a birth certificate, a name, and Social Security number, you can open up a 529 plan, account, I should say, and that is owned typically by the parent. So mom or dad, it can only be owned by one. It cannot be owned jointly. So either mom or dad opens up the 529 plan, or you each can open up a 529 plan. You would name your child as a beneficiary on that account, and then you can start making tax advantage contributions to a long-range higher education funding account, that's what a 529 is. It's not just for college anymore. It was set up that way originally, but now the use of that money has expanded dramatically as they made tax code changes throughout the year, and now it can be used at almost any educational institution of higher accredited institution of higher learning. And so that includes things like trade schools, trucking schools, beauty schools, HVAC repair, computer repair.
Radio broadcast.
Is there a radio broadcast school, right? So as long as it's accredited for higher learning, then the funds in a 529 plan can be used for that purpose. There are a little bit of income restrictions on it that people aren't. Some aren't aware that. Now you can contribute a lot of it. Like I think the limit is up to almost $250,000 in total over the lifetime of the account. But technically, on an annual basis, what you as a parent put into this account that you own, but you have your child as a beneficiary, technically what you put in there is considered a gift. And when it comes to gifting rules, then there are annual gifting amounts called exclusion amounts that you can give up to without any tax implications. But if you go over that amount, then there can be some filing requirements on your annual tax return. So for this year, you can gift to anyone, and any one person can gift to another $19,000 this year, and you can put that amount without any tax implications into a 529 plan. Now, a 529 plan, all the 529 plans are administered by each state. So there are 50 different 529 plans in America. Fortunately, most of the people who are listening to me right now live in a state that has one of, if not the best, 529 plans in the country. It is certainly, I learned recently, the largest 529 plan in terms of assets. So the people who built, and administer the Virginia 529 plan have done an excellent job. We're one of the best ones in the country. And your contributions to that plan can get you a Virginia state tax deduction up to $4,000 per year per account. So doesn't mean you're limited to contributing only $4,000. You can certainly give more. You can give up to that 19 I said without any gift tax ramifications. And really you can give more than that, but then some gift tax filings come into play. So you can give whatever you want. It's just a matter of how much administration goes along with it. And then each year for that contribution, you get a $4,000 contribution, and if you gave more in a year, then that amount carries over to the next year. So let's say you gave $6,000 this year, that means you can deduct $4,000 this year, and then $2,000 in 2026 from your Virginia state tax return. And then alternatively, and this is another strategy you can use, you could make a lump sum contribution up to $95,000 to a 529 account and elect to treat it as if it were made evenly over a 5-year period. So again, another mechanism to give more than that $19,000. You can sort of bunch. The tax code allows you to bunch about 5 years of that $19,000 contribution up to, which would be $95,000 in 1 year, and then you spread out that gift over 5 years, and then you do not have to pay any gift tax on that contribution. And then, one of the questions that usually comes up from a lot of people, okay, so what happens if my child doesn't go to college? Or what happens if I contribute too much and we don't use it all? Well, then, number one, you can just transfer it to another child if you have more than one in your family, or you could transfer it to a niece or a nephew or a grandchild. It can be transferred. The beneficiary can be changed on the 529 plan to somebody else, so it still can be used for higher education. Or ultimately, if it was never used for that, then you can convert a certain amount, and I forget that number off the top of my head. I'm going to say it's like $35,000 from the 529 plan into a Roth IRA for your beneficiary child. Now, the account has to be open for at least 15 years, but if you start it when your child's a newborn, then certainly by the time they're even going to get to college age, you would have met that qualification. As long as you've had it open for 15 years, then you can transfer the money from the 529 into a Roth IRA and give your child, who ostensibly did not use all the money for higher education, a good head start on their retirement planning by opening up a Roth IRA. Okay, just got a couple minutes left in our last live show of the year. Might be a good time to remind everybody, have there been any changes to your family, your heirs, or have you bought and sold any major assets this year? So, if any of those things have happened, consider reviewing your estate plan. At Wealthway, we generally recommend our clients get their estate plans reviewed every 7 to 10 years. Even if nothing has changed in your life, there could have been changes in laws or tax code that would merit changing aspects of your estate plan. So having them reviewed every 7 to 10 years is a good practice. And I'm going to wrap things up here with a holiday tip. Here's a holiday family activity idea. Since most people are either going to visit family this holiday season or have family coming to visit them, you're probably going to be around a lot of extended family. Might want to consider having a family meeting, a relaxed end-of-year conversation to share where important information can be found, files, passwords, that type of thing, to your close family. That's all the time we have for today. I'll see you in the new year live. I'm certified financial planner Kevin Zibna. You've been listening to Dollars and Common Sense on News Talk 790 WNIS.